When a company drops its earnings reports, it's like opening the result envelope on award night. Traders, investors, hedge funds, everyone is waiting to see if the company beats expectations, meet them, or completely miss the mark. And depending on that reveal, price action can turn into a calm wave or a full-blown tidal surge. During earnings, companies reveal how much money they made, how much they spent, and what they expect for the future. And here's the twist. Sometimes a company posts great numbers, but the stock still tanks. And here's why. Because Wall Street wasn't impressed, or the expectations could have been higher than reality. And other times the results are just okay, but the stock still shoots up because traders were expecting something a lot worse. In just a few minutes, spreads widen, volume spikes, and algorithms fire off like fireworks. And this is why many traders either love earnings season or avoid it like a thunderstorm. A lot of the times though, in order to avoid gambling, it is better to place your trades after the earnings report has released. So let's go and jump into what earnings is and how it affects the market. Inshallah, God wills. So we're going to go ahead and cover earnings. So what happens when financial earnings release? Okay, so every quarter, okay, every couple of months, financial earnings are going to be a report that determines the amount of money that a company made, okay, and the amount of expectations that they were trying to arise to. So if a company was projected to make $500 million, but they only made $300 million, then in that case, they would go ahead and lose earnings. Okay. But if a company was projected to make $500 million and they made $800 million, then that would go ahead and be a positive earnings beat. Okay. So earnings are going to go ahead and determine the price action too. Now, just because earnings gets beat or earnings loses doesn't mean that a stock will head up or down. Okay. Stocks will do whatever it wants. Do not try and use the earnings releases to try and gamble and make trades. Okay. Try and trade after earnings releases if you're going to put down a brand new position. Okay. Wait for the price action to kick in. And then after the earnings release comes, then feel comfortable to make your trade. But never trade like a day or a couple of days before earnings. Wait for earnings if you're a couple of days before earnings. Okay. Wait for earnings to come out and then take your setup. Okay. Because otherwise it could be gambling. Earnings causes stocks to make giant moves quickly. Okay, so the moves that happen during earnings are going to be extremely instant, and it's going to be like a flash move based on the report. So let's jump into it. So the quarterly report, right? 10Q. Okay, every 3 months, public companies are required by law to reveal their financial health to the public to let them know how they're doing. Okay, it's going to go ahead and let investors know if they want to keep throwing money into the company or not. If a company is not beating earnings, then that means that they're not making any type of income. Okay. And a lot of the times we don't want to be invested into something that's not even making income in the first place. So every 3 months, public companies are required by law to reveal their financial health to the public. Okay. And let's talk about the revenue. So revenue is going to be how much money came into the door. Okay. How much money did that company make during that quarter? And the net income is going to be the bottom line. It's how much profit is left after expenses. So certain companies might have to pay for building power, warehouse cost, employees cost, etc. And the EPS, it's going to stand for earnings per share. And it's the profit divided by the number of shares that are going to go ahead and be available. Okay. So EPS, net income, and revenue. Those are going to be the 3 factors and the 3 things that are shown on the quarterly reports. Okay, so let's keep jumping into it. So the expectations game, right? The actual numbers don't matter as much as the expectations. Okay, so once again, let's say a company was projected to make 100 million, right? Expected, but then they actually made 170 million. Okay, that would go ahead and give them a beat result. Okay, so whenever you hear the words beat, that means that the results that actually came out were going to be better than what was projected or speculated in the first place. Okay, so priced in. If everyone expects Apple to make $1 billion and then make $1 billion, the stock might drop. Okay, why? Because the good news was already bought weeks ago. Okay, so to see a stock pop, a company usually needs to beat company earnings, okay, and beat the analyst consensus estimates based on the company's averages is how the estimates come out too. So it's not just going to come out with random numbers. If a company is making around like $50 million a year, okay, the earnings might be around like 60 or $40 million expectations. Okay, it'll be around where the company is performing as of recent years. Okay, so don't just expect the numbers to just be some random inflated numbers. These are all numbers that are going to be based in and baked into averages for a reason. Okay, earnings come into play. But once again, don't try and just hop in a contract the day before earnings trying to trade like that. Please don't do that. Okay, please don't do that. Now, sometimes there's going to be little rumors as well too. You'll see like, oh, this company's going to be earnings. Nobody knows what's going to happen until the earnings report actually comes out. So please do not lose money gambling for no reason. Okay, wait for the earnings report to come out. Unless you're in a hefty swing already, please wait for the earnings report to come out. Okay, let's keep going into it. And understand that guidance is going to be king. So stocks trade on the future, not the past. Okay, so guidance. Guidance is going to be the company's prediction for the next quarter, how much money they're going to be making. Okay, it's pretty much going to be giving the company a trail and letting them know how they should be performing in order to get to the next level. So in any scenario, company reported record profits, okay, but let's say next quarter looks slow, okay, then that'll be the future. And results, okay, the stock would go ahead and crash if that's the case. So we're lowering our outlook due to supply chain issues would equal an instant sell-off, since that means they're pretty much letting us know, hey guys, the company can't expand right now because of financial issues. Okay, so guidance in the future of the company is also going to be really, really important too. There might be times where a company might lose or not beat their financial earnings, but then end up making a pretty profitable couple of next quarters. Okay, so one quarter is not going to go ahead and determine a company's entire worth. It's the consistent stream of quarters and reports year after year after year after year. If a company is consistently losing earnings, then that tells you about the company. Okay, so we'll talk about the implied volatility crush. So IV is going to stand for implied volatility. So before earnings, options prices can get very expensive. This is called high implied volatility. So it's like buying insurance right before a hurricane, okay? Or driving your car and then you just put insurance on it, you know? So before the release. So uncertainty is high, so options get more expensive in this case, okay? So if you are going to buy a contract before earnings come out, okay, make sure you sell it before earnings come out too. Don't gamble and sell your contract after earnings comes out, because then the uncertainty would go ahead and vanish. Okay, unless you're playing for a way bigger take profit that's going to be way further out than you think. Okay, then try and sell your contract before the earnings comes out, because it's going to be worth the most expensive then. Okay, so buying options right before earnings often loses money, even if you guess the direction right. So if you buy a calls contract and the company beats earnings, and even if price goes in the upwards direction, okay, you might notice that your contract didn't even make you that much money. Okay, that's because price has to get rebaked into what it actually is supposed to be. So do not buy earnings before expecting you to catch the right direction. Okay, because even if you do catch the right direction, you're probably not going to make as much money as you would think. Okay, especially depending on the contract that you buy. Okay, the reasons why contracts get expensive like that before earnings is because they don't know what the number is going to go to. Okay, that's why. So implied volatility makes things more expensive. So understanding this really helps us. Let's head over to the next slide. And let's go ahead and let's talk about the gap. So earnings are usually released after the market closes. So it's usually after 4 p.m. Eastern Standard Time. Okay, or it's going to be before market opens. So it's going to be before 9:30 a.m. Eastern Time. So you cannot trade standard stocks during the release unless you have extended hours access. So a lot of the times, once again, just like I talked about earlier, you're going to see that instantaneous price action. So the stock price will teleport, so it instantly gap up or down. Okay, and stop losses do not work against gaps. If you hold overnight, then you're going to be taking the full risk. So just know that even if you have a stop loss placed during the day, if price decides to run through wherever your stop loss is, then what it's going to go ahead and do is decide to not validate and just ignore all of those orders due to the fact that the price action is happening pre-market and aftermarket. Okay, and you can only maneuver your options contracts. If you have shares, you can close a little before or after. Okay, but if you're on options, you gotta only get what you get when you wake up to the contracts. Okay, so even if you see price going in an upwards direction and you had some calls, don't expect money all the time. It really depends on a lot of things such as implied volatility, etc. Okay, so expectations matter. Okay, so beating estimates are required a lot of the time for a stock to go in an upwards direction. Okay, in order to start seeing a rally, and guidance is going to be critical. So the future outlook is a lot of times going to go ahead and overshadow the past results. And volatility crush. Options lose value instantly after the news. Okay, so you might notice a contract might be $500 before the news. Okay, and then after the news, it might go down to $200, even if the number were to go ahead and hit. Okay, so options lose value instantly after the news. And the gamble between everything. So holding through earnings has a high risk. Okay, just a high risk factor. I'm not even going to say high reward. Okay, because the reward that you were to get is not even worth it, and you wouldn't even get it as properly as you would. Now, if you're holding a super swing, okay, you're trying to hold a trade for months, weeks, some years, etc. Okay, then I do understand. Okay, do your thing and hold your trade as you need. But a lot of the times, make sure you're closing your trades before earnings come out. Okay, unless you know exactly what type of swing that you're holding. Okay, head over to StackMODE.net to learn more about anything stock related, investing related, or trading related. I'll catch you guys in the next one. Peace.